Bank earnings season in full swing. Some of the big banks already reporting, and now the focus will shift to the regionals starting tomorrow. Joining us now, a look at what to expect is David Chiaverini, Wedbush Securities Managing Director. David, we'll talk about the regionals just a bit, but I'm curious to get your headline take so far from what we have heard from the big banks.
Yeah, so far, what we heard from them wasn't too entirely surprising, although what was interesting in terms of a read-through for the regional banks and the mid-cap banks is JP Morgan, when they were talking about credit quality, they mentioned they were seeing some incremental weakness in middle market commercial. And that is kind of a bread and butter type of business for the mid caps and the regionals. In terms of deposit flows, no big surprises there, a little bit higher for JPM, a little bit lower for Wells Fargo. But what really took investors by surprise were the results from State Street, ticker STT. So their non-interest bearing deposit mix shift was much larger than what some investors were expecting, and the stock really took it on the chin on Friday when they lowered their NII guidance to down 12 to 18% sequentially in the third quarter. So the big bank earnings weren't entirely comforting for the mid-cap banks, but the silver lining is that JP Morgan and Wells both did increase their net interest income guides for the year. Now, JP Morgan did also say not to expect this higher level of 87 billion to continue. They're cautioning that the run rate could go back towards the mid 70s. So a little bit of good, a little bit of bad, but it will be interesting to see how the regionals play out this week.
Well, David, how do you expect the regionals to play out? Because clearly the group has been under a tremendous amount of pressure ever since the stress started to emerge within the sector back in March. We did get a little bit, I guess, reports in terms of the fact that they were on stronger footing, some of them, in the last round of results. What do you think we'll hear this time around?
Yeah, so unfortunately, I do think that the net interest income revisions are going to be guided lower for the mid cap. So even though the big banks did see their NII guides go up, I think that the deposit pressures and the mix shift from non-interest bearing to interest bearing deposits is going to be too much to handle for the banks, at least in this earnings season. Now, the hope is that, when they reset guidance lower this earnings season, that it will be more achievable and attainable, and that the downward revisions kind of subside with this earnings release. But that's the main thing we'll be keeping an eye on, as well as funding costs overall. I think credit quality will still be excellent in this quarter, but we'll be keeping an eye on to see if there's any early signs of cracks.
What about the big question around potential regulation?
Yeah, no, excellent question. Regulatory capital requirements. That is the big open-ended question. For the big banks, it's pretty clear that we're going to see roughly a 20% increase in capital requirements for the likes of JP Morgan and Wells Fargo. What the chatter is that that's going to apply only to the biggest banks. Now, in terms of other regulatory impacts, the line in the sand is likely to be around 100 billion. What some people are talking about is potentially the accumulated other comprehensive income, AOCI, so the mark-to-market losses on securities portfolios, that could be included now as a hit to capital as opposed to being excluded from capital. So we'll find out the Basel III endgame rules pretty much any day now, and could be upwards of another month or so.
David, when it comes to credit quality and the deterioration that we are seeing in commercial real estate right now, how manageable will some of the exposure to the office sector be in terms of the banks that are at the most risk within the regionals?
Yeah, so the good news is that this should play out over time. So the banks still are in a positive profitability position. So given that the average life of these loans is over multiple years, so only a fraction of the outstandings are coming due each year, they should be able to manage any potential hits and loan losses related to it. Now, will the losses be there? Yes. Are banks setting aside additional reserves? Yes, they are. But we don't think it's going to be a 1 quarter event in which if it were to all happen in 1 quarter, then sure, the banks would take a big hit to their capital in that quarter. But given their profitability, it should be manageable over time.
So not a 1 quarter event, but which bank is most exposed to the commercial real estate sector?
Yeah, so there's a few ways to measure it, but for the regional banks, Comerica is at the upper end of the spectrum, as well as M&T Bank are at the upper end of the spectrum as well.
Wedbush's David Chiaverini, good to talk to you today. I really appreciate the time.